Hey everyone, welcome to the Story Trading Weekly Meetup. We got another new stock pick for you tonight. But first, a quick disclaimer: Story Trading is not an investment advisor. Investing in securities involves significant risk of loss. If you're watching this replay on social media, first I want to show you a quick little video about what Story Trading is about.
It's not easy to understand why stocks go up and down, but even in volatile markets, there's always a discoverable and logical reason behind price action. Story Trading is a social investing community of investors who share information to uncover the hidden stories behind the trade through the 4 pillars of fundamentals, catalysts, sentiment, and technicals. All price action can be understood through the lens of these pillars, allowing for a holistic view that empowers better decision-making. Only by understanding markets can you beat them. Join our community today and start making sense of markets.
So there you have it. That's what we do. It's story trading through collaboration. We look at the 4 pillars to understand what's going on with the stock. So tonight we have an important member of our community, Matt Kolb, who's had a few home runs for us, presenting ACTG. It's a $213 million market cap company. Last trade, $4.54. There you can see the chart. And I invited him on because I did take note at a high level. I didn't do a deep dive myself yet, but I did think that catalyst seemed significant, and the technicals kind of seem good here as well for a little bit more of a move at least. So we're going to turn it over to Matt so we can learn more about this company and put these puzzle pieces together so we can understand a little bit more about ACTG. Matt, you there?
I'm here.
All right, take it away.
All right, so this is my largest position. The book value is $8.80 a share, but it's vastly understated to what the actual book value is because they own 8 biotech companies, 3 of them that they're holding on the books at cost. And one of those companies is about to get a drug approved. They got it delayed based off of packaging. And anytime that happens, it's just basically like a hiccup. So that company is called Viamet. They own a 26% royalty stream in a company called Mycovia. Sorry, I want to get my screen. Oh, you're pulling that up. Okay. Try to minimize this. So yeah, Cliff Press is the CEO, Rich Rosenstein, the CFO. This is my largest position because I like to buy stocks trading at a fraction of what the breakup value is. So as of Friday, it closed at $4.50 a share. And they just reported earnings at the end of March, and with a stated book value of $8.80 a share. So, like, I like to shop at Marshalls. The reason I like to shop at Marshalls is because I can buy a $100 shirt for 20 bucks. Same thing here. And I didn't back this company because of Acacia. I don't know if you guys are familiar with Starboard, but they are considered one of the best activists, one of the best investors of all time, really. And they are backing this company. Right now, they own about 30% of the stock via 365 preferred. And their whole goal with Starboard and Acacia is to become the next Berkshire Hathaway for small cap investments. Okay. And so how are they going to do that? Well, they have about $1 billion worth of capital to, there you go. You pull that up right there. You're ready to go. So they've been involved and they've done some amazing deals so far. The first deal they did, they bought about 20 biotech investments, and it's been an absolute home run. They're probably going to make about $300 million on that investment, maybe more for that investment. And the whole market cap's $212 million. All right. They have a patent business. They just settled with Samsung, and now we're going to go after Apple most likely. They had a $50 million revenue number in the 4th quarter alone, and they did about $80 million in revenues last year. And I expect not as much unless Apple comes in 22, but overall I see multiple different catalysts, things that are going to be good. So the 3 business units. Let's back up. So the first business unit is their IP business that I just referenced. Okay, their IP business, they're a patent company, so they're going after Apple, Samsung, anyone that's violating patents. They have a huge patent portfolio. So that's one of their business, but that is the least reason why I'm involved. Anything that patent business generates is icing on the cake. Okay. The second business.
Can I pause you for a second? Just big
sure.
picture. I'm a little confused, or maybe I missed it. ACTG, Acacia Research, is a patent company?
No, well, that's one of their 3 business units.
Okay.
So they have 3 different business units. One of them is a patent business. So they're considered one of the best patent companies in the world. But to be honest, that is not why I'm involved in it. Just anything that they generate from that, like they just got a $50 million settlement from Samsung. It was out of the blue. You know, that was like they generate 30 million of operating income. That was just icing on the cake for me. Okay. I could care less if it generates any more money because of the other 2 businesses. And really it's
what am I looking at? What am I looking at right now? It says enterprise value negative 300 million, 400 million.
That's not possible.
Okay.
I mean, it's trading at at a negative. Yeah. Oh yeah. At a negative 3. Yeah. That could be right. because the value, it's negative. Okay. But yeah, because it's they're trading at a fraction of their assets.
Yeah.
So
okay.
Sorry, I thought it said 300 million and that didn't make sense to me. So their second business is they're a publicly traded venture capital firm taking stakes in companies, but that eventually will go away. They ideally don't want to do that, but so right now they have 8 biotech companies. One of them is a company called Oxford Nanopore. And Oxford Nanopore is like basically the leading genomics player out there. It was the hottest IPO in London. You probably not, you wouldn't have heard of it in America because they spurned the US to become, because they're from the United Kingdom, to have this amazing launch. But if you've traded like Invente, NVTA, or Pacific Biosciences or Bingo, this company is the next, oh my God, I'm drawing a blank. It'll come to me. The massive player in genomics. It'll come to me. But so Oxford Nanopore is Illumina, ILMN. So everyone's telling me, and from my research, that Oxford Nanopore right now has got a 4 billion market cap, can be the next Illumina. So if you guys have ever had your COVID, and if I have COVID right now, I'm going to get it sequenced. Most likely it's coming from Oxford Nanopore. So they have a great genomic business. They have a sequencing business. They have a testing business, which is a very small part of their business for COVID. But they are the future of, when you go into the doctor, you're going to be using their technology. Okay. And so that's one of the 8 companies that they still own left. Oxford Nanopore. All right.
Is this a holding company?
Yes and no.
Okay. Because I'm looking at their website and their website doesn't say much. Except we seek to acquire undervalued businesses.
So they have the 3 businesses, right?
Yeah.
So the patent business, that was their main business. And then they got involved with Starboard to diversify. That's where they got into these other 2 things. Okay. And the second business is the 8 companies. There was 20 originally, but they already sold 12 of them and made a lot of money. Okay. And then the third business is they have up to $1 billion worth of capital right now to acquire all kinds of small cap companies. So they have active bids out for Kohl's, KSS. It was one of the biggest stories. I don't know if you remember this from a month back, but they made an acquisition offer with Starboard to buy out Kohl's. They have an active acquisition out for a company called Spoke, SPOK. And I don't know if they still have an active bid out for a company called Comtech, CMTL, but that's the third company that they have active bids out for. Now, they have made one acquisition. It's a company called Printronics. They bought it at 3.6 times EBITDA. So, that's going to be a cash flow machine. Okay. So my strategy right now is it's trading at a fraction of book value. You have a catalyst coming up, possibly of a restructure of the 525 warrants that Starboard has. Okay, so they have a big warrant out at 525, and both Starboard, the company, and the investors know that the way that it was originally structured 3 years ago doesn't make sense. And I really believe that that will be restructured by next earnings call. And that could unlock at least $1 to $2 worth of share value just based off of unlocking that warrant or restructuring it. Okay. So my whole thesis is not the 8 biotech companies. I think eventually they're going to monetize and sell them off. But my thesis is they will become a holding company. They will be a mini Berkshire Hathaway, and they're going to own. Their goal is to own, I don't know, 100 plus small cap companies going forward. Now they only have one right now. They have 3 bids. And once you become a holding company and you own a lot of assets that are spitting out cash, you're not going to trade at a fraction of book value anymore.
Why is it so cheap now? Why is it traded at a fraction of book value right now?
Well, because I would say there's 2 reasons. One, the warrants, the 525 warrants. But I think once those go away or get restructured, more institutional investors will be involved. Number 2, it's a small cap, so obviously people don't like small caps. Starboard is heavily involved, so any institutional investor is gonna have to deal with Starboard. And I think the final reason is because they've only in 2 years outside of the big biotech where they just earned $1.91. So last year in 2021, they earned $1.91 per share. I mean, stock's trading at $4. And I think 2022 is going to be even bigger if they can close on some of these deals. So I think the market is discounting. They have not been successful in taking out companies, and I think the market is waiting for them to secure their first big deal.
I'm looking at this long-term chart of book value versus enterprise value. I'm not an expert in this by any means, but I don't know if that's a correct comparison to look at. But you see, it's basically kind of same trend, same direction until recently, until last year, where book value kept going up and enterprise value kept going down. Interesting.
Yep. And then it was a completely different company before 2019. So it was just a patent troll. And I got the day that Starboard got involved is the day I got invested in it at $2 a share. So it went up to 8. I've traded in and out of it, done options. This is in my long portfolio. I'm in it for Starboard. I'm in it for because they're just so amazing. Like, I've followed their work for years, and I like them better than Icon. It's just Jeff Smith is one of the best investors on the street that some people know, some people don't.
Jeff Smith is who?
Yeah, he's the founder of Starboard Value.
Right there.
He's like, it's him, Icon, Ackman. It's, if you could Google Jeff, like, he'll come up as the best activist. I mean, here's why you want to get involved with Acacia. So he used to take these really big activist stakes in large cap companies, mid cap companies, but he could never take out those companies because they were massive, right? So he wanted to have his might and start acquiring unloved small cap companies, turn into a holding company, and this is his retirement, right? So he's not looking at it as a stock for 3 months, 1 month. He's looking at this as being a multi-year Berkshire Hathaway type of opportunity.
You've been in this since, is this when you got in? This was the turning point, November 18th?
Yeah, I mean, that's when I first got in at $2. Yeah.
Okay.
Yeah.
November
And so, I mean,
18th.
I've traded,
Right here.
I've done a lot of options, cover calls, right put, there's been a lot of things I've done since that time period, but I have, a core of my position, and there's just so many levers to unlock that will make this an amazing investment. So why I like investing in this, if the stock market, the best thing, okay, I didn't even say this. So 3 million shares have been knocked out of the float. They bought back $15 million worth. And at the earnings call, they just did a $40 million buyback, which is 20% of the entire outstanding. A little bit less at this point. Yeah, but yeah.
Hold on. They announced an additional 40
million. On top of 15 million that was completed in the first quarter.
Okay, so 15 million was already completed, and they announced another 40 million. Did they
Yeah.
give any kind of guidance or context in terms of how long it'll take them to buy back that 40 million, or what prices they may be interested in doing that at?
Well, I mean, if the book value is 880, my guess is they're buying all the way up to 550. That's just my guess. They didn't say, but they said they're going to be aggressive.
Book value is 880.
Yeah.
Okay.
But I mean, this is a growing book value. This is, I mean, like I said, I've given you SVBC before. Like that one is a very illiquid, you know, the disparity is much bigger, but these guys are backed by real money, real companies, and have a plan to like really take this to the next level. Like if they can take out Kohl's, or even if they don't take out Kohl's, right? So they own SPOK, they own some shares in Spoke and Kohl's, right? If they took a big position in Kohl's at 40 bucks and they made an acquisition at 65 and they fail, they probably made 50 to 100 million dollars just on their Kohl's position. So there's like 3 or 4 companies looking to buy Kohl's right now.
All right. So what's the bear? You mentioned a little bit about the bear case, but if you can reiterate what the bear case is and what the risks are here.
Well, I guess the bear case is there are 8 biotechs, you know, completely fall apart. 3 of them are private. But here's the issue with that. One of the 3, you could pull up the last earnings call if you can.
All
right, now go down, 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 go down. Where's it at? Keep going. Oh, there we go. All right, those are the 8. Those are the sorry, 7 companies. They must have sold the 8th. So Viamet right there. Okay, that company. So all 3 of those companies are valued at $25.7 million, which is their cost. Okay, Viamet, in my estimates, based off of public, a company called Malin did a public estimate of what it was worth. It's worth between $200 and $300 million. Okay, on approval. And they had an FDA review, and it didn't get approved. It got pushed back because they had some packaging issues, right? It wasn't anything on the drug. Packaging means like, you know, the label, all that other stuff. So that'll be solved. They told me, the company, they expected to be approved in the 2nd quarter. All right, we're in the 2nd quarter. And as soon as that's approved, Acacia is going to get a large royalty payment. So I've done some work, and I believe conservatively it's worth 200 million to 300 million bucks. So I guess the downside is that doesn't get approved. And that would, you know, that would not mess with the current book value, but I think some investors, including myself, are pricing that in, right? Or the smart ones, at least. Now, Oxford Nanopore could fall back. You know, that could raise some book value. I guess they don't restructure the warrants, the 525 warrants. If that happens, doesn't happen, then that could, you know, limit upside probably to the 6s. Yeah, so I would say those are the bear cases, or they make a really bad acquisition, right? That's a bear case too. But knowing Starboard, like the last acquisition they did was at 3.6 times EBITDA. Okay. You know, they're not dumb investors. They're buying Kohl's, I think, at 7 times, you know, if they can close on it. So they're gonna, and what they're gonna do is they're gonna slice and dice. They're going in there slicing and dicing and using their connections to grow revenue. And this is, you know, this is Gordon Gekko stuff. I mean, these are the type of investors I like to back and get involved with.
Interesting. I got someone doing some research here in the chat saying it's $377 million net cash after all liabilities, which is about $7.70 per diluted share. You're saying there's warrants of $5.25, so that's cash that would come into the company, right?
It would be cash that would come into the company. But
how much is left there? How many warrants?
So it'd be 60 million shares, so it'd be 300 million more bucks.
Oh wow.
Yeah. So that's why. Yeah, but here's why that's going to get restructured. Okay. Starboard, given their original arrangement at their 365 preferreds, they own 30% of the stock, right? Okay. They don't want to own 70% of the stock. They can't. Okay. There's a rule. I forgot to even tell you this. They still have 170 million of NOLs. That's worth, what, 40 million?
Wow.
So yeah, they have 170 million of NOLs. It was announced in the last press release. And so Starboard does not want to own 70% of the stock. They can't, right? I mean, no institutional investor will get involved. So the company has told me, it's being looked at, right? They said Starboard, them, and all investors, no, the warrants need to be redone, right? So my guess is they'll go away. They might have to pay, something for it, because there's also, in the original press release, we were supposed to participate in the same terms as Starboard. So the fact that we didn't get that participation, the company knows that, maybe we can get rid of those warrants and the stock goes crazy and Starboard makes money, we make money, we're all happy.
Well, this seems pretty interesting.
Yeah. So pull up the last press release, you can see the NOLs.
Yeah, I did. I highlighted it. There it is.
Okay. Okay. Yeah. Oh, sorry. I'm in the chat above it. And so I'm trying to think if I'm missing anything else. I mean, you have upside if they settle. So Samsung settled. They're the main players in Wi-Fi 6 patents. They're going after Apple next. So if Samsung settled for 50 million bucks, Apple's not gonna. Apple knows they're screwed. That's how I look at it.
Help me understand this chart, because I get the math, I get the story, but it's a little bit disconnect here with the price. Why did the price get this low, and why is it only 458 now? What's going on?
So it spiked to that $8 level, right? When Oxford Nanopore was like the hottest company in the world. It still is. It's pulled back a lot. And that was like in February of, the small cap malaise, or the small cap boom. To be honest, I have no idea why it's pulled back. I think it's crazy that's pulled back. That's why it's my top position. Because especially since the book value has went from, the 4s to 880. And they have so many levers that aren't even in the book value. It popped from the low 350s after earnings, when they said they're going to buy back 20% of the stock, and I know they're going to get aggressive. There's 57 million shares outstanding. If they can knock out, everything at $5, that's an extra 8 million shares gone. And you can see, like, look at how much they earned, last quarter, that year. I mean, it was a monster year. So I have no idea. They earned $1.91. I have no idea why nobody is buying the stock. And the only thing I can think about is the warrants, or just it's too small and maybe they don't want to get involved, because with the warrants, technically Starboard owns 70% of the outstanding, 30% without of it.
Yeah, I mean, I guess the easiest explanation is the macro and the indices being down, and people just, small caps being out of favor, and that's always the easiest explanation. Yeah.
But I mean, the company's absolutely crushed it. I mean, and if they can, so I would be shocked if they didn't have a large Kohl's position. Absolutely shocked. And there's 3 companies going after Kohl's. I actually don't want them to win it. If they win it, great. If they have a huge position in Kohl's and they can make 50 to 100 million bucks, half the market cap, I'd be okay with that.
Did we lose Matt, or did I lose Matt?
What? So when Kohl's dropped, like here? Right there, they were the ones that put the order in.
His
right?
internet's there.
I think it was in like the 40s.
That was my internet.
So, and then they own a position called Spoke. They have an active offer out for a company called Spoke, SPOK. SPOK, yeah. So I think they have like an $11 bid, 1075, and they're excited about this.
How are they going to afford to pay these? Like Starboard would back them up?
There's a bill. I mean, in the last press release, it says they have up to $1 billion in capital. So they have cash on hand. They can sell positions.
Right.
You know, Starboard will loan them money.
Kohl's like a multi-billion-dollar company? How much is Kohl?
Yeah, but so unlike the other offers, I think they have a pre-deal to sell the real estate. When I spoke with the company, they said they have very eclectic financing, unlike the others.
Yeah, Kohl's is a $7.4 billion company. So give me just a high level how that would happen with $1 billion.
Because the value of the real estate is, I mean, I can't remember what the articles have said, but it's in the multi-billions. So my guess is they would already have the real estate sold off.
Whose real estate?
Kohl's. So if they complete the deal, the real estate would be sold to a third party.
Oh, it wouldn't be part of it. It would be for the core business.
Correct. So they sell. So what they do is they make an offer, but you know, and the offer would be along with selling the Kohl's real estate.
Got it. Okay.
But they have $1 billion in cash, you know. So and they told me at one point it could be up to $2 billion. So it's $1 billion listed. I mean, Starboard is a monster. I mean, the Wall Street will do anything for Starboard. I promise you.
Yeah, I gotta look at this press release. What does Starboard need Acacia for? Well, why don't Starboard just do everything by themselves here?
Well, they needed a public vehicle to do it, and then they wanted the net operating losses, which was $300 million. They basically bought the $300 million of NOLs for free.
I see.
So, like, why start a new entity if there's $300 million of NOLs and they got, Cliff Press, the CEO, used to work with Starboard, and then just this last press release, they brought over one of Starboard's main guys to run M&A for Acacia. So I'm not in this for the Acacia team. I promise you that. I'm in this because Starboard's backing it.
Got it.
Now, I like the Acacia team, but they're not my bread and butter.
Okay.
I just trust. I mean, like I said, I loaded up. I didn't even know what the deal terms were on the Starboard thing. Once I saw that, I just bought as many shares as I could that day. I've been following Starboard for years.
You've done well.
Yeah.
All right, cool. Well, if anyone has any questions.
Yeah, ask some questions in the chat. I don't know if I missed any or.
Go ahead and raise your hand, or actually, let me change the security settings. You can go ahead and unmute yourself, raise your hand, or throw in a question in the chat. This is something I don't have a position in now. I'm glad we got the opportunity to hear about it. I have like different portfolios for different purposes. Like this is something that is more like an investment, instead of cash. I think you just
it is. That's how I view it. And then you can write options off of it too, especially when it gets volatile, and then if it gets taken away, it gets taken away.
Sanjay has a question. Do they intend to keep the patent business?
They do, because they're experts in it, and they can buy, like, I think a couple quarters ago they bought something at pennies on the dollar, and they've already made a ton of money off it. So, like, I mean, this $50 million deal, they bought, I think, it from Yahoo about a year and a half ago also. I mean, so there's good returns in the patent business. It's just they're never going to talk about the patent business ever, because they're trying to acquire companies. So they have to, there's a thin line that they have to tread, because they don't want to be known as this patent company anymore. They want to be known as this aggregator of unbelievable small caps, unloved, that will become loved again.
They should buy Kodak.
To be honest, here's the greatest thing. They want me pitching them ideas all the time.
Oh, yeah?
If you see something and it's good, like, I've pitched and had many calls about stocks that I'm looking at. I had them looking at SVBC. I had them looking at Synchronous. I've had them look at lots of different companies.
Wow, interesting. Okay.
So yeah, they want that. That's their thing. Like, we're not a hedge fund, right? We want the hedge funds to bring us ideas, is what they tell people. Like, we'll help you monetize your gains.
Interesting. Well, it sounds like a unique opportunity and a unique relationship you have with these guys.
Yeah.
All right, you got another question. I may have missed it. Is from Karthik. I may have missed when he said Starboard would eventually acquire ACTG.
No, they won't.
No.
So that's not like they want this to be a public company so they can acquire other businesses. That's what they want to do. They don't want to acquire Acacia. They want to acquire multiple different small cap companies. Now, if they were to own all the shares, right, they wouldn't be able to do it. So their whole goal, right now, they own 30% of the outstanding, 70% with the additional warrants. Like I said, those warrants, in my opinion, will be gone or restructured.
Okay.
And they're not going to be buying growth stocks. So this is a value play. They're going to be buying. They'd be buying oil companies back when oil was dead. You know, they're like right now they're looking at all the tech wreck. You know, I mean, they're not going to go in there like the biotech assets they bought for 10 cents on the dollar, right? So they are shark investors, right? They bought Printronix at 3.6 times EBITDA. I mean, come on, that's a steal.
Interesting.
3.6 times EBITDA. So like anything, my guess is they'll buy things between 4 and 9 times EBITDA, and then they'll fix it up, and either they'll resell it or they'll keep it in the portfolio. That's their plan. So some of the companies that they're going to acquire, they're going to resell. Some of them they're going to keep. No, so let me rephrase. The biotech business was an opportunistic deal. There was an investor. I can't remember his name, but he was in Europe. He was the considered one of the best investors in all of Europe, and he blew up his portfolio. I mean, literally, he went from the best to the worst. Oh my God, what is his name? Let me look it up real quick. Neil, whatever. It doesn't matter. I'll come back. But so basically, in the height of COVID, they had to liquidate these portfolios, and they got Oxford and 20 other biotech companies at like a fraction of the cost. So actually, biotechs they had no experience in, but they knew paying so cheap, they had access to capital, paying so cheap, they would be able to make a fortune on it, and they did. I mean, it was an absolute one of the best trades of all time. So the biotechs, there's 7 of them. They will eventually all be sold, and then all that cash will be redeployed into buying companies at 100%, or at least majority. I don't know. Maybe they would do a 51%. I don't know, but from my understanding, they want to own companies outright, and that's the play. Because think about it. If you go from a book value story to an operating business, they're going to start valuing you on price to book, earnings growth, all that other fun stuff. So my guess is $12, $13, $14, right? You give it a multiple on, let's say you have $1 billion worth of, spitting out $200 million of cash flow. It's not going to trade a $200 million market cap. I promise you that. Now, like I said, I am pissed at them because it's been 2 years and they haven't executed on any deals. Now, actually, the last year, it's actually been fortuitous because valuations were insane. So I have to give them credit for being very astute and not making a bad decision.
Mm-hmm. Yeah, there could be a lot of great deals this year.
Yep. Oh, and they said they're the busiest they've ever been. Like, I mean, I'd recommend. It was a really good conference call. It was just like a week ago, so it's fresh.
Yeah, that's good to look at. I'm also looking at this as the original press release with Starboard. Interesting, gives you good high level overview of what they're doing and what's going on here. Mm-hmm. Yeah,
terms have changed a little bit from then, but I mean, they didn't do all the 365s because the stock ripped so fast. They couldn't, issue any more 365s. So that's good for Acacia. And we also didn't get to participate at the same terms. So I bring that up to the company all the time.
Cool.
Yeah. This is in a crash. Like, okay, I'll give you an example. I mean, the only stock I was buying in March of 2020 was this stock. Like right when everything was hitting the fan, I was buying every share I could.
Wow. And okay, so I mean, is it because in a crash they're going to have good opportunities to buy other companies? Is that
Well, yeah, there's
the idea?
twofold. One is trading at a fraction of its assets,
Right.
right?
Mhm.
And most of their assets are in cash. And two, on a crash, yeah, they're going to have a million more opportunities, and there's not going to be many people with liquidity like they have.
Wow.
It's not
I'm
just
gonna write this
liquidity
down.
they have the name behind them.
Yeah.
Right. This is not like if this was Acacia, I'd be a little bit more concerned. It's Starboard. You're backing Starboard. You're not backing Acacia.
Got it. All right. I'm gonna have to move this up in my priority list, do some homework on this. I think you sold me. I think I might have to grab some for my safe money portfolio.
Yeah. That's where it is for me.
Yeah.
And I mean, you got support. They're buying back 20% of the outstanding here. They're not going to let it drop. If they do, they're going to buy every share they can.
Right. Good points. Interesting. All right. We have a question from Sanjay. What's your relationship with Starboard?
Mine?
Yeah.
Well, I don't have one. I just love them. I just think they're amazing investors. It's like, some people love Carl Icahn. Some people love, Ackman. Some people like Kathy Wood. I like Starboard. You have to go look. So all right, let me go back and look at what they've done. There's a Forbes article about the greatest activists. They're ranked above all the other activists, above Ackman, above Icahn, above everybody else. So just look into the success that Starboard has had.
Okay. And I guess it's talking about, because you mentioned you pitch ideas to them. So that's why he was asking about relationship, but I guess anyone can.
Well, no, I pitch ideas to Acacia, not to Starboard.
Oh, I see.
So Starboard is just an investor, and they're doing things with Acacia on a high level. But if you want to talk to the company, you got to talk to Acacia.
Okay. Okay, interesting. All right. Any other questions? Anything else you want to add, Matt?
So they did tell me. So here's why the stock hasn't moved. It's been bad. They've done zero investor outreach because, and here's the reason why. And I think this is why the stock has went down. I forgot to mention this. It's because they haven't executed on acquiring companies. Like they just own pieces of businesses right now and a bunch of cash. It's not exciting. But as soon as they start executing on deals, they're going to get analyst coverage. Like right now, it's just Craig Hallam. They're going to be doing a lot of really cool investor outreach and doing a big push post deals.
Let me see that Craig Hallam. Let's see if it's in here. Analysts. Yeah, you got one analyst. I guess that's the Craig Hallam over there.
Yeah,
next quarter,
he was wrong. I mean, he had a $5 million revenue estimate. They came in at 50 million in the fourth quarter.
Oh, crap. This one that says current quarter, December. Yeah. They didn't update this yet.
Yeah. See, they came in with a $50 million revenue. Yet the stock only went up 10%.
Interesting.
31 million in operating income. Nobody knows about it. Nobody cares yet. They will.
Okay. I like it. You always bring us good unique names.
Mm-hmm.
Hey, what do you think's happening with if I can ask you a couple of your other stocks you pitched to us? Well, you mentioned SVBC.
Yeah.
Any new thoughts on that SVBC stock you presented before?
So in May, there's going to be the annual meeting, and I think the management potentially could get kicked out. Last year, they lost by 150,000 votes. I mean, the book value on this one is 14, might even be higher, but this one is a little bit more risky. I mean, it's not risky based off of where it's trading, but it's not. They have three very illiquid companies, right? Where Acacia has very liquid cash, very liquid companies, and the one of the three illiquid companies that's not public is a gold mine for Acacia. Like I said, look into Mycovia. So I don't know if there's any women here in this group. I don't have the list up, but they focus on women's health, Mycovia, and they have a drug for RVVC. So for yeast infections are absolutely nasty and they come back. Their drug crushes yeast infections and they don't come back. Okay. The data has been tremendous. So I'm hearing it's $1 billion company.
Where is that? I don't see that on the list here of the
So
seven.
Viamet owns a 26% royalty stream of Mycovia.
Okay.
So it's a royalty stream. So as an approval, they're going to owe them a lot of money. And then based off of sales, right? The peak sales of $1 billion, they're going to get paid a lot of money based off of sales. So what's going to happen is anyone that acquires the company is going to want to buy the stream of income too. So, I mean, Viamet could get taken out at any point.
Okay, cool. Sounds good. Maybe
so we talked about SVBC. So they own like 6 or 7 positions, like 5 major ones, and the top 3, you know, are involved with electric vehicles, healthcare. I mean, you know, we have the semiconductor company that's in the SiC play. So I feel very comfortable. Eventually, so here's what happens. I mean, they're not doing anything for the shareholders. I like their IR guy. I like them, but they've failed. So in May, if they get voted out, the stock could double or triple overnight. Now they got to get voted out. That's, you know, and then, Wrightspeed, their EV company just made a major, look that up. They just did a deal with a public company, Wrightspeed. Look that up.
How do you spell it?
That's Wright, WRIGHT speed. And hit news. Romeo powered. They're public too. And he was the founder of Tesla. The owner of the founder of Wrightspeed was the founder of Tesla. So if they ever go public, which I think they will, that's going to get a lot of hype.
All right, Matt, another great name. Appreciate that. Any final questions from the audience? I don't see any. So what we'll do is, 1 second. There we go. Is my screen sharing? All right, we got the story. So let's continue collaborating. Let us know in the VIP research room if you guys are interested in this name. We'll open up a group just for ACTG. I think I may be interested in doing that, but if you are interested in this name, just let us know tonight. Put a little message in the VIP research room what you thought of Matt's presentation, and if you want to collaborate more on ACTG, and we'll take it from there. Matt, thank you so much for that awesome presentation.
No problem. I mean, I'm in the WhatsApp group too. You can always message me personally if you have a question. And then I can look at some ideas from time to time as well. Okay,
great. Thanks. We're going to hang on a little bit over time here for our VIPs. This part's not going to go up on social media, but goodbye to those watching on YouTube.